Welcome to the Demillennial Dealmaker podcast, where we talk about all things deal making, investing, and wealth building related. Enjoy our newest episode of the podcast. Thanks for listening. What is private equity? Private equity is capital that is not listed on a public exchange and is usually composed of funds and investors that directly invest in private companies as well as engage in buyouts of public companies, which results in the delisting of public equity. Private equity is considered an asset class that involves investing in public and non-public companies, usually in physical assets that involve real estate and private businesses. The stakes usually involve a majority or large minority ownership stake in a company. These type of investments offer stronger risk/reward profiles than the traditional stock market indexes and public company offerings. However, investing in private equity has substantially less liquidity compared to the public market opportunities and requires longer investment and holding periods. Depending on the investment strategy and capital available at hand, traditionally a private equity firm seeks to target investments with a 3 to 5 year exit point and have invested capital return 2 to 4x on most occasions, with a benchmark internal rate of return in the 20 to 30% range. In general, private equity firms typically will raise a significant amount of debt capital to purchase the assets that fit their investment criteria to minimize the initial equity requirement up front. The investment strategy my firm will utilize is the leveraged buyout. The leveraged buyout is the most ideal investment strategy for a majority of private equity firms. There are numerous investment strategies and capital options available in the private markets, and the main ones include venture capital, growth capital, mezzanine financing, leverage buyouts, and distress investing. In a typical venture capital investment, the result is the investors taking a minority investment in a company with high growth potential with minimal revenues. The majority of these investment types occur in a company's life cycle in the early stages. Most VC deals result with the investors taking equity stakes in startup businesses with opportunities historically having a high risk/high return profile. This injection of investment capital is more popular to the newer companies because they generally do not have access to the debt markets for raising capital. Once in a while, VC investments have the chance of blockbuster returns for the investor. For example, an initial upfront investment could be seed funding needed for the company to start building its operations and scaling up. When the company proves that it has a viable product, it can have more future growth by obtaining Series A funding. Traditionally, a startup company will have completed several rounds of series financing before making the move to go public or to be acquired by another financial sponsor and/or a strategic buyer. In these cases, it's not uncommon for VC deals to return 10x multiples or higher on invested capital to their investors. The next main category includes growth and/or growth equity. Growth equity is a private equity investment in specific companies looking to enter new markets, restructure operations, invest into R&D and new product development, but usually want to maintain control of the business. Growth equity is also known as growth capital and is deployed in firms usually more mature in their life cycle and are not early stage firms. Growth capital is usually raised from various sources that include private equity and/or late-stage venture capital, hedge funds, or family offices. Growth capital investments typically consist of a private equity firm making a majority or minority ownership stake in an early-stage company. These investment opportunities typically involve companies that are more developed than classic VC investment companies, making them less risky than VC investments, but with less upside potential. Growth equity firms tend to do extensive research on various industries and market trends in order to identify the most lucrative investment opportunities. These type of firms continue to look for companies where their value-add expertise is relevant so these companies can realize their market potential and become respected market leaders in their specific industries. This comes in a variety of forms, which includes strategic guidance, operational support, management expertise, and optimized capital allocation. Historically, a successful growth equity investment will return to investors usually a minimum of 2 to 3x multiple on invested capital. The next main category includes the leveraged buyout, which is a financial transaction in which a company is purchased with a combination of equity and debt, in which the company's cash flow and/or assets is used as collateral to secure and repay back the borrowed money. The debt portion is usually 60 to 70%, while the remaining equity portion is usually 30 to 40%, typically funded by a financial sponsor, with a traditional holding period of 5 to 7 years, and an exit by a strategic buyer under financial sponsor or IPO. Typically in these transactions, there is an acquisition of a publicly or privately held company, usually categorized by the higher amount of debt financing used for the acquisition compared to the equity financing used. In a leveraged buyout transaction, there is reliance heavily in the future cash flows of the acquired business to service the necessary interest expense on the debt, with the intent of paying down the outstanding debt as swiftly as possible. The initial paydown is small at first due to the initial interest expense burden being substantial. In this paydown amount, the total account will grow each year as the company continually grows its cash flow, with the outstanding debt balance decreasing steadily from previous paydowns. In essence, when the total debt balance is lowered, the total value of the company will increase, with the equity portion of the company capital structure growing more rapidly. In this deleveraging process, it will lead to substantial gains for the holders of the equity portion in a successful LBO investment. LBO transactions come in all shapes and sizes. Total transaction sizes can range from tens of millions to tens of billions of dollars, and can occur in target companies in a wide range of industries and sectors. Due to the reliance on high leverage, a typical leveraged buyout firm must be skilled at creating optimized capital structures for their designated target companies during a process called financial engineering. LBO firms in general rely on this financial engineering technique as a core skill in their investment strategy when compared to other strategies like growth equity, who uses a strategy that focuses exclusively on company value creation. At the core of a leveraged buyout transactions includes a type of financing called mezzanine financing, which is where a private equity firm uses this kind of financing, typically in the form of subordinated debt, which can include junior to senior debt and/or preferred equity, where the returns have return expectations of 15 to 20% per year. In general, mezzanine financing offers an investor compensation in the form of interest combined with upside participation. The options include equity or warrants/options on equity. Due to its expensive nature, companies will often search for other sources of capital before turning to mezzanine capital. This type of capital can fill the gap between senior debt and equity nicely. When a private equity firm chooses to do a leveraged buyout transaction, this mezzanine financing will help lower the acquired amount of equity capital invested in a leveraged buyout transaction, where the equity capital traditionally has a higher required rate of return. With mezzanine financing, however, quite expensive, can help reduce the overall required rate of return on the capital used to execute an LBO transaction. By lowering this required equity investment, it makes LBO deals more feasible that otherwise were not easily executed. The next main investment category includes distress investing, which in basic cases includes a distressed company that shows several signs of financial strain. Investing in distressed securities means purchasing the equity in fixed income securities of companies that are either in bankruptcy or have a meaningful likelihood of filing bankruptcy in the near future. In the majority of cases, these companies have claims against them that are higher than the value of their assets. In essence, these distressed companies don't have the cash flow necessary to service their debts. In this investment strategy, there's a transaction called a distressed buyout, where in most cases a private equity firm purchases a financially distressed company below market value with the intention of divesting the company in the future for a higher valuation. The two major cases of distress for a company include the excess use of financial leverage and operational volatility, such as the cyclical nature of a business. Before the execution of a distressed buyout opportunity, a distressed buyout firm needs to make the necessary judgments about the target company's value, survivability, legal, and the restructuring of the company's assets, and whether or not the creditors of the target company would become equity holders within the company. If the creditors do indeed become equity holders, they will then require many rights as full or partial owners of the business, and this will bring issues in regard to the control of the business. How do private equity investments create value in the marketplace? There are critical functions that private equity firms perform, which include deal origination, such as transaction execution, and portfolio oversight. The deal origination process involves creating and nurturing relationships with merger and acquisitions intermediaries, investment banks, and similar transaction professionals to secure both high volume and high quality deal flow. Deal flow refers to prospective acquisition candidates, which are usually private companies that are referred to professionals for investment review. Firms have the option to outsource deal flow through systems and to reach out to company owners to generate transaction leads. With the competitive nature of the M&A landscape, sourcing strong proprietary deal flow can secure the funds raised are successfully deployed and invested. Additionally, due to the nature of internal deal sourcing efforts, it can reduce the transaction-related costs by cutting out the investment banking middleman's fees. When the middleman in this case, which are the financial services professionals, represent the specific seller, they will run a full auction process that will decrease the buyer's chances of successfully acquiring a particular company at the price they want. Due to this hindrance, deal origination professionals need to establish longer and stronger relationships with transactional professionals, which takes a lot of time and energy. A key point to this is that investment banks often raise their own funds, which conflicts because they are not a deal referral but also a competing bidder with private equity firms when looking for solid companies to buy. There is a high level of expertise with transaction execution, which involves assessing management, the industry, historical financials and forecasts, and conducting the necessary valuation analysis. In most cases, the investment committee will choose to sign off to pursue an acquisition candidate that meets their investment criteria. Then the deal professionals will submit an offer to the seller. If both parties decide to move forward, the deal professionals work with various transaction advisors, that investment banks, accountants, lawyers, and consultants to execute the due diligence phase. This due diligence process includes validating management's stated operational and financial figures. This is a critical point in the process because consultants can uncover deal breakers such as significant and previously undisclosed liabilities and risks. Private equity investment strategies. When it comes to doing the deal, there is a plethora of private equity investment strategies, with the most common including leveraged buyout investments, which is the one my firm will focus on. Leveraged buyouts are simply done by the way they sound, where a target firm is bought out by a private equity firm or a part of a transaction from a whole group of firms. The purchase is financed and or leveraged through debt, which in essence is collateralized by the target firm's operations and assets. The acquirer in this case is the private equity firm, which seeks to purchase the target company with funds acquired for the use of the target firm as a sort of collateral. In essence, in this leveraged buyout transaction, the acquiring PE firms are able to purchase companies with only having to put up, in most cases, half the purchase price or even less. By leveraging the investment, private equity firms' main goal is to maximize their potential return, which is the preference of most firms in the industry. A popular technique and strategy that is starting to show a new light is the ability to execute leveraged buyouts for the use of low-cost leverage using the SBIC program. Historically, the Small Business Investment Company / SBIC program has in most cases attracted mezzanine debt funds. This trend has reflected that the Small Business Administration / SBA was focused on protecting the government's capital and was therefore reluctant to license many of these types of buyout funds. But this technique was not shown in a favorable light because of the private equity community's lack of appreciation for how the SBIC program can be used to support a buyout investment strategy. In a majority of circumstances, the small buyout funds focus on the disadvantages of the SBIC program, which involves the concentration limit, the current pay requirements, and the impairment rules while ignoring the numerous benefits which involves having instant access to low-cost leverage to do leverage buyout deals. Oversight and management in private equity. Another important function of private equity professionals is the oversight and support of the various portfolio companies and their management teams. Among other support work, they can become more involved in a young company's executive staff through best practice in strategic planning and financial management. Additionally, they help institutionalize new accounting, procurement, and IT systems to increase the value of their initial investment. When it comes to more established companies, PE firms believe that they have the ability and expertise to take underperforming businesses and transform them into stronger ones by increasing their operational efficiencies, which results in an increase in earnings. This is one of the main drivers of value creation in private equity. However, PE firms can also create value by aiming to align the interests of company management with those of the firm and its outside investors. Also, a favorable technique is to take public companies private, in which PE firms remove the constant public scrutiny of quarterly earnings and reporting requirements, which in essence allows the PE firm and the acquired firm's management to take a more long-term approach to increasing the profits of a company. In a PE firm, usually management compensation is directly tied to the firm's performance, thus adding accountability and incentive to management's efforts. These increased incentives and efforts allow for optimized performance, which leads to the acquired firm's valuation increasing substantially in value from the time it was purchased, creating a profitable exit strategy for the PE firm in the form of a resale, an IPO, or another option. Investing in upside in private equity. A popularized exit strategy for private equity involves the growing improvement of a middle market company via selling it to a large corporation for a nice profit. The larger transaction investment banking professionals will focus their efforts on deals with enterprise values worth billions of dollars. However, the vast majority of transactions reside in the middle market, between $50 million to $500 million deals, and lower in the middle market, which is $10 million to $50 million deals. Due to the popularity of the larger deals, the middle market is significantly underserved market with a lot of untapped potential and opportunities. Therefore, there are significantly more sellers than there are highly seasoned deal professionals with the extensive buyer networks and resources to manage a deal. A significant company metric for private equities investors includes earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. When a private equity firm makes an acquisition, they work together with the management team to increase EBITDA during its investment time horizon, usually in the 3 to 7 year range. A good portfolio company can typically increase its EBITDA both organically and through acquisitions. What are the best books on private equity? In my opinion, the best books include number 1, Barbarians at the Gate, number 2, King of Capital, number 3, Mastering Private Equity, number 4, The Masters of Private Equity and Venture Capital, number 5, Berkshire Hathaway Letter to Shareholders, number 6, Web of Debt, number 7, The New Tycoons, number 8, The Debt Trap, number 9, Gods at War, number 10, Billions to Bust and Back. In summary, in the private equity industry, with assets under management already in the trillions, private equity firms have become more attractive investment vehicles for wealthy individuals and institutions. This broad understanding of private equity and seeing how value is created in different private equity investments are the first steps in entering an asset class that is gradually becoming more accessible to individual investors. Stay tuned, the Millennial Dealmaker, out.